Good afternoon. This is the IronFX oil market review for the 25th of November. My name is Angelos Zitis and I will be hosting this report. So we give a few seconds to the disclaimer. And we make a start. So the oil market performed a comeback in the previous days as volatility rose substantially. Both WTI and Brent oil gained notable ground and somewhat reversed the downward trend line the commodities were in since the start of November. This report will cover the current most important matters driving oil prices. We will be looking into the weekly oil data along with some fundamentals, while at the end, as always, we will be providing a technical analysis on WTI, identifying important levels for traders to consider. So we start first with the weekly oil market data from the US released in the past days. During Wednesday, the Baker Hughes weekly oil rig count indicated active rigs increased by 6 since the previous week and continue to be on the rise in November. The average increase in active US oil rigs has been higher in November compared to October. No substantial reaction was observed upon release, yet the data in our view is a clear indication of greater oil demand. On the same day, the weekly EIA crude oil inventories figure indicated a surplus of 1 million barrels, which did not really impress traders and minimal reaction was observed. On Tuesday, the API inventory levels displayed a considerable surplus of 2.3 million barrels, which forced WTI prices lower upon release. This is evidence that significant numbers can motivate traders to place orders. Thus, the pre-mentioned data should be monitored in the following week. Lately, the media made a substantial turn to the oil market after major consuming countries announced the release of their strategic oil reserves. Countries including the US, China, Japan, India, South Korea, and the UK have all confirmed their intentions to insert their oil reserves to their markets and possibly bring oil prices lower. The market's initial reaction to the news was unexpected, as oil prices basically rose in consecutive hourly sessions on Tuesday, which is quite the opposite of what the overall target of the actions was about. Our personal view is that the indirect message received from such an action by the largest oil consumers of the world is that the oil market remains mostly undersupplied while demand continues to grow. The news not only pushed oil prices higher, it also made room for stabilization at higher grounds to prevail. According to Bloomberg analysts, higher prices can make US oil more expensive for domestic use compared to what they would pay to import oil. Once again, in our opinion, using national oil reserves is a move that can support the market temporarily, while we don't know what the impact on the oil market will be if the barrels are not replenished soon for any reason. On a separate note, other analysts view the move as competition towards the OPEC Plus group that seems skeptical on whether production should remain at current levels or should be increased in the short term. Traders will be locked in for next week's OPEC Plus meeting scheduled for December 1st to 2nd to set policy. The group's views and decision on production can be crucial for understanding further price action movement and the industry's current challenges. Our view is that OPEC and its distinguished partners like Russia are currently the dominating force in the oil market, thus headlines coming from countries forming the group should be monitored by traders. We move now to our technical analysis. Please note this is WTI's 4-hour chart. At the moment, WTI is seemingly returning lower after testing our R179 resistance level and was unable to breach it. However, if the commodity has the volatility to move substantially higher, then we note the R2 8085 resistance as the first possible test for the bulls, while the R3 82.75 line is, in our view, the ceiling and was tested various times in October and November. To the downside, we note first the S1 76.70 support, while even lower the S2 75.10 level was tested various times in the past 10 days, but was not breached, confirming this level remains solid. Our lowest level for this analysis remains the S3 73.05 support. We emphasize the range between the R179 resistance and the S2 75.10 support, which is highlighted with yellow on our chart. The price action moved within this area in the past days and can be used as an indication of strength of the buyers to the upside or the bears to the downside. The RSI indicator seems to be leaning to the downside at the moment, just crossing the 50 level. The indicator's level implies traders may be in a wait-and-see position for the time being. That's that, ladies and gentlemen. This report was specifically put together for all the oil market traders out there with the intent to provide the best information, and we thank you very much for your time. If for any reason you would like to contact us, please send an email to research_team@ironfx.com. From everyone here at IronFX and myself, Angelos Zitis, best wishes for solid trading.